So today's Cardinal Lessons, we're back to the tax brackets, tax rates. My wife, she tells people that are just meeting me she says, I just want to warn you, my husband finds taxes interesting. So anyhow, we're going to go on with this today. And I really want to bring Tom on, and I want Tom to share with all of you like why we're doing this video today.
Hey man, we're doing this video because you have a silent partner in your IRAs, your traditional IRAs, your traditional 401ks. And that's the IRS. They are a partner in there. You owe them taxes. And so what we want to do today is really talk about how we can buy them out in the least expensive way. At some point we're going to have to pay taxes on this money. How do we do this the most efficient where we pay the least amount we can over the life of this money? And so I'm going to bring up the show notes here. You can find these at the link below our video. They're also on our website. Again, we just have the board on there, and then this page is something I use daily. I have it sitting on my desk. It has a lot of really good information. That's just one thing you can look at very quickly. But we spend a lot of time focusing in this upper left-hand corner, which is really what's on the board, is looking at where those tax brackets stop, where the 22%, the 24%, we'll get to that in a second, with some other things on this sheet. But what we do a lot in our practice is planning around this, looking at Roth conversions, and we'll talk about that here a little bit. But again, these show notes are, if you were to print anyone out, this might be one you want to just have available. I do, at least in my desk. So
Okay, so if we look at that upper left-hand corner and we look at the brackets, I just want to give a little schooling on this, is the married filing joint, which if you're married, most of the time it's advisable that you file a joint tax return because the IRS has made it very penal on people that are married that want to file separate returns. Sometimes there's reasons to do it, but financially, it generally works out better to file a joint tax return. And people that are in these lower brackets really got a big benefit from the Tax Cuts and Jobs Act. Everybody got some benefit, but the people in the middle class and the lower brackets that went in 2018, and these rates came way down and these brackets went up significantly. And so we'll just talk a little bit about what they are, is that, if you have a taxable income of $94,300 as a couple, your marginal tax rate is 12%, and you're not paying taxes on 12% of your money. You're paying 10% on the first 23,000 and 12% on the next 70 some thousand. So we don't want to get into too deep of a lesson on the brackets, but what we're going to focus on today is the top of the 24% bracket. You say, well, why are you doing that? Because a lot of this video is about Roth conversions. This is where we use these brackets when we're looking forward, and we're looking right at this year, possibly doing one this year, and then next year and the year after, and so on and so forth. And it seems like many of our clients settle on filling up the 24% bracket in its entirety, whether they're married filing jointly or they're a single person. And with a single person, that's 191,000 of taxable income. So another way to look at this is if your taxable income in a year is 100,000, okay, and that's what you're filing every year as a married couple, or that's what you're going to file for this year, and you let the year go by without doing a Roth conversion, you've left $283,000 of taxable income on the table. When the year is over with, you can't do a retroactive Roth conversion. So it's another way. If you're a single person and you've got a taxable income of, say, $80,000 a year, and you've left about $110,000 of potential Roth conversions on the table, because you could have done that, and the highest rate you would pay at the federal level is 24%. Now, you'd have to add your state income tax, if you have one, to that number. So we use these brackets prospectively, where we look to the future, or we look at the current year, but it's still the future of the current year, and we try to arrive at a number that's acceptable, and we settle for people that are going to do Roth conversions, spread them out over a few years, we settle many times at the top of the 24% bracket. Now, there's a lower number at 22 that some people settle on, and then some people just pick an amount of money, like do $100,000 a year. But we still use these brackets in calculating how much additional tax it's going to cost them to do this conversion. Okay. Now, I want to call your attention to the standard deduction, because since the Tax Cuts and Jobs Act, many people don't itemize anymore because they give you a pretty substantial standard deduction. $32,300 is the married couple filing jointly that are both 65 and over. A little less than that for the people that aren't 65. And for the single, 65 and over, it's about $16,500 that you're just going to get in tax write-offs whether you itemize or not. I mean, it's an amount that the government throws in there. So that can be added to, those numbers can be added to this to arrive at the tax deduction. So I want to bring Tom on, and I just want to find out what Tom has to say about the brackets in general in Roth conversions.
Yeah, I mean, I think this is, if you start looking at these brackets and you go back and look at what the brackets were prior to the Tax Cut and Jobs Act, and those are the numbers that they're going to revert back to in 2026. It doesn't line up perfectly, but essentially what is the 22% tax bracket now is going to become the 25% tax bracket. What is the 24% bracket now is going to become the 28% tax bracket. And so you start looking at what those numbers are going to be just in a couple of years. That 24% bracket is a really sweet spot where you can get money out. It's really wide. I mean, you can make as a couple $383,000 as the taxable income. So you actually can get more gross income than that. We'll talk about that in a second. And only pay the top tax rate you're paying is 24%. I mean, that's pretty sweet. And so that's why we pick that bracket a lot of times. Some people, if you have just really, really large IRAs or 401ks, we might recommend you actually go into the 32, 35% because you need to do more than you can to really make a dent into your 401k or IRA. But a lot of times the 24% is a sweet spot. And like Hans was mentioning, is these numbers on these brackets is determined by your taxable income. And so I don't want to get too deep into the tax form, but if you looked at your 1040, they got all these things, they add all of your gross income, and you get to a number called your adjusted gross income, which will be higher than your taxable income. From that, you get to subtract things like the standard deduction, or if you itemize the itemized deductions to get to the taxable income. So you could look at this bracket and say, I'm going to convert up to my gross income of 383. You actually can do a little bit more than that, maybe closer to 400,000 if you're a couple, to still stay in that 24% bracket. So maybe don't try that on your own. If you have questions, call us. We can help you do it. But it is something that it's a really, in our opinion, taxes are on sale now. So let's go ahead and start getting money out of these accounts because who knows what tax brackets are going to be in the future. I mean, our opinion is they're going to be a whole lot higher than they are now.
Okay. So now we're going to talk just about some Roth conversion planning ideas that we use in our practice. Roth conversions work best if you perceive that taxes are going to be higher in the future than they are now. Okay. And I just asked you that right now do you think higher taxes are going to be higher in 2030 and 2035 and 2040 than they are now? And if that's so, then Roth conversions are something you should consider. Now, consider smaller amounts over several years, and that's what we've been talking about earlier. I mean, we have a number of people that are like 65 going on 70, and they're going to take the next 5 years, they're going to delay their Social Security, then they're going to create an income out of their IRA, which we can help them do, and we can even make that a guaranteed income for what they need to live on, after the tax is paid on that. And then whatever that number is, they can safely add $100,000 a year in Roth conversions for taxable income. And so we have just a lot of people that convert 500,000 over 5 years, 100,000 a year. These are for people with very large IRAs, and they'll just do that. And so that tends to lower the amount of taxes. It lowers the pain in writing the check for the taxes. And it's a pretty smart strategy. With people that use annuities, we'll sell them 5 different annuities now for 100,000 each, and then they'll convert one of those every year for the next 5 years. And then when they get to be 70, they've got their Social Security check coming in, and then they also have a nice pool of money that they can start drawing on that'll be tax-free. Now, that's just a simplified version, but of doing it in smaller amounts over several years. RMDs cannot be converted. I want to bring Tom on to just talk a little bit about this.
Yeah, I mean, so I think this really, once you get to the age where you have to start taking RMDs, and they keep moving this. I mean, people turning 73 now, that's the age. If you were born after 1960, it's 75. But at some point in the future, the IRS says you have to start taking money out. You are not able to do Roth conversions on that amount of money. I mean, you might think like, well, I got to take money out anyways. I'll just convert it to the Roth then. It doesn't work that way. Is you have to take it out, pay the taxes, and not are able to convert that. Um, that doesn't mean you stop doing Roth conversions at that age. You could still do them. You just need to take the RMD first. And so, what this really speaks to is really think about doing Roth conversions prior to then. So, I mean, if you're retired, maybe you're 65, you've retired, and we have, I don't know, could be 10 years, depending on your age, 10 years or 8 years, is you might have a window of time where we can do Roth conversions, not having to worry about the R&Ds, lowering the traditional IRA money, the balance of that, which is how they calculate your RMD, which makes your future RMD less expensive, or you have to take less out at that point. And so it works well in that range of people. You could do conversions earlier. Some people we have in our 50s doing Roth conversions. Be a little bit careful if you're doing that. You can't hold the tax money out of the conversion. So after 59 and a half, you don't have to worry about that piece. And so I don't want to get too deep into the logistics of how all this works, but it's a very nice time to do the Roth conversions prior to the RMDs, because it makes the RMDs less in the future, and it's you're not able to convert those once you get there.
Okay, so now the next point is consider the impact on Medicare IRMAA. So this is approximately the Medicare IRMAA line. Or in other words, if you're single and your taxable income 2 years ago was less than 100,000, it's a little more than that now, but we're just going to use this. Or if you're married filing jointly, if your joint income was less than 201,000, and it's actually a little bit more than that, but we'll just use the top of the 22% bracket as if you're under that, under the top of it, you'll not pay IRMAA. If you're over that, if you get into this 24% bracket, then IRMAA is going to be a factor. And IRMAA stands for Income Related Monthly Adjustment Amount. It's the Medicare tax. It's the way they charge you extra because you have a high income and you're on Medicare. So it's just a way to tax well-to-do people extra on their Medicare payments. And so when we're doing Roth conversions for people that are already on Medicare, this is a consideration. And I want to bring Tom back on because I just want Tom to talk about, what we think about paying a little IRMAA voluntarily because you want to get the benefits of the tax.
Yeah, I mean, I think IRMAA is a consideration. We think about that in all the plans we're doing. We don't let it drive every decision we make. I think that's a mistake. Some people come in and they are just hot about this. They didn't know it was coming. They got this letter, and now they're doing everything they can to possibly avoid it forever, which isn't always the best planning strategy. And so we want to consider it. We want to think about the impact it has on your plan in today, but also into the future. Because if you have a large IRA balance and you don't want to do the conversions because I don't want to pay any IRMAA, well, it's a little bit short-sighted because you might get to RMD age and the RMD alone might push you into the bracket where you're having to pay the IRMAA, and now you're set up to pay IRMAA for the rest of your life. And so sometimes it's a question of, do you want to pay it now or do you want to pay it later? We also, if you're a couple, we need to think about the impact it has when the first spouse passes away, because this is a really sort of a hidden, death tax, if you will, is when the first spouse passes away, that surviving spouse, their income normally doesn't decrease that much. It goes down a little bit, primarily around Social Security, but the RMDs don't change really at all. And so now they're having to pay taxes on the single rates, which on the board is the right side of the board. You can see you get to those higher brackets a lot more quickly. Their income hasn't changed. So now they've lost a loved one. They're having to pay higher taxes in the future and potentially higher IRMAs too, because the IRMA levels are lower for a single person. So we want to consider it. We want to think about it. We don't want it to drive every decision we make. And a lot of times we are recommending people go ahead and pay some IRMA now to get the tax benefits of these Roth conversions. And it just really what we want to do is we tell the clients that this is happening. This is what we're doing. It's part of the plan. Just expect this in the future. That way they're not surprised about it, because that's really where people get upset, is when they didn't even know it was coming. They did all this stuff and then they get this letter 2 years from now saying, hey, by the way, we're going to charge you double for your Medicare, whatever the amount is. It doesn't always have to be double. But it's something we consider. We don't let it drive everything we do.
Okay. Now, what I want to tell you is, I want to emphasize the word consider. So we're not so pro Roth conversion that we recommend Roth conversions for everybody that comes in to see us. That's not the case at all. What we'd like you to do is consider them, and openly consider them, and just be logical about this stuff. And sometimes it's wise to pay some taxes now to avoid taxation later. Now, the last point that we're going to make, and this is kind of a tough one to bring up with a recent widower, but the last year, the year of death of the first spouse, the couple still gets to file a married joint tax return. And I would ask you, if you're doing Roth conversions, would you rather be on the left side of this chart, or would you rather be on the right side of this chart? So many times when we have a person that passes away during the year, we're going to talk to the survivor about doing a fairly large Roth conversion in that last year, just because they can take advantage of these much higher brackets, or lower rates, if you will. And then they're going to be minus one Social Security check the next year. So availability of tax-free money would be kind of sweet. So with that being said, I want to go over in holistic financial planning, holistic retirement planning, looking at all 7 of these subjects, or the 7 worries, which ones apply to this video. I mean, the whole video has been about income taxes and income tax brackets, income tax rates, income tax planning. We've talked about estate and passing your money on tax-free to your heirs. We talked about income and income tax. And of course, we've covered 401k and IRA, because that's where the money is currently. And it's taxable in the future. And we want to get it to be tax-free. So I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.